Hey everyone, it's John at Rain King LLC. It's Friday, February 10th, time for a general market update. Again, a reminder, this is from Rain King LLC, and I'm an amateur individual growth stock investor, not affiliated with IBD or MarketSmith. So today's agenda, we're going to just quickly go over the big picture. Want to go over some market internals. Then I thought it'd be interesting to compare the 1962 bottom to the 2022 bottom. And then I want to get back to searching for leadership in 2023. And then we're going to answer the question, how is this pullback developing in the indices? What's the report card so far? So big picture, again, the long-term monthly trend lines, we bottomed right around that 10,000 to 11,000 range, still in the super cycle that I've talked about on previous videos. Let's look at a few of the internals. This is the New York Stock Exchange advanced decline line on the left. And you'll notice that a couple of the different trend lines have been broken. This is a weekly chart. And you'll notice that this steep downtrend line has been broken. And you'll also notice in the pink line here, much more this downtrend has now been broken. And we've come up and we're just about ready to make a new high in the advanced decline line, which is really positive when you consider the S&P, which is shown above here, has not quite gotten to a new peak. So the advanced decline line right now is leading. It's positive. On the right side, this is the S&P percentage of stocks above the 200-day moving average. Again, this is a pretty positive picture. The level that we're at right now, if you draw a line horizontally, you'll see we have not been at these levels since the beginning of 2022, and that was actually the top of the market. So this is also a very, very positive, improving picture. Next chart here is the NASDAQ, looking at net new highs, new lows. And again, you'll notice that we finally have gotten into net new highs on a more consistent basis. Over the past month in 2023, we've had somewhere between 70 and 100 net new highs. That's very good. If you draw a line from that, you can see we have not been at that level. The last time we were at that level was really back in the April through the summer. We had a periodic time that we were in there. But if you really want to go back to more persistent look of a bull market, we go all the way back to, this is 2020, starting in April, Mayish. You'll notice that net new highs in this rising bull market, new bull market, were typically between 150 to 200 for the first 2-3 months. And then they really accelerated into the end of 2020, where you can see the new highs were 200, 300, 400. That's also interesting to note that we're finally getting some positive action, but we're not yet in the box yet of the 150 to 200, but we're only really a month into the new year. So I thought this would be interesting. Let's look at the 1962 bottom and some similarities to 2022. So on the left, this is the Dow Jones Industrial weekly chart, 1962 bear market. And it was characterized by 3 waves down. You'll see here the first wave. The second wave is pretty devastating, sharp decline. I pointed out at this point, there was a huge volume day and a big, big reversal up. That really was the end of wave number 2. And it really was climax washout selling in the Dow. It was about 25% off its highs. And ironically, that was right about in June of 1962. There became another leg down, which was a little bit sharper, but briefer, and we undercut the lows. And then there was a follow-through day, day 4, in this particular bear market. Now, if we turn our heads over to the right, this is the S&P in 2022. We had one leg down that took us down to in March. Then we had the second leg down, which bottomed out kind of in June. And then we had another rally over the summer, and then we had the third leg down, undercutting, very similar to the third leg undercutting in 62. What's interesting about this is a lot of people say, well, we haven't had capitulation selling. We haven't had capitulation selling. This bear market is really not going to be over until you get this washout of selling, as you can see in the 62 market. I would challenge people to be open to the fact that we did have washout selling. We were 25% off the highs by June. And what's really interesting in considering this a washout was the weekly new lows were 50% of all the issues that were traded. That's a washout. And you can see the volume really bumped up. So this really might have been the capitulation selling, because you'll notice that many growth stocks actually bottomed in the May and June timeframe, even though the indexes went lower. So if we pick up the tail in the 62 market, we came back down and we tested the October lows. Now, this retest was associated with the Cuban Missile Crisis, what's going on in the U.S., and it wasn't until the standoff was resolved and the USSR ships were turned away that the market had a recovery, and then went on a very, very strong rally. And you'll notice that that rally coming off that retest had a wall of blue, lots of big blue volume on above average volumes. That's really positive. Interestingly enough, we had also a retest of the October lows, came down, retested, we got a follow through day, and we also started to have this little basin here. And then you'll notice that what the 62 market did is when it came off that last retest, it came up, and that the interesting is, look at how it held in this green box. It held its gains. There are some tight closes in there, very, very constructive. And then in 1963, the Dow Jones made an 18% gain for that particular year in 1963. So back to where we are, we're starting 2023. Interesting that we're in this box and we've come out of the little basing area. Can we hold our gains similar to what we had in 1962? Remains to be seen. But what's interesting, I thought, was, we're at the beginning of a new year, and question mark, we don't know how the year is going to go. But in the back of our minds, we do have the January trifecta. And then when we get the trifecta, the average gain is ironically about 17% for the year. We started to see the beginnings of some blue volume, which is positive. But I thought it was an interesting corollary that the following year, after a bear market, in this case, 63 gained 18%, and if the January perfector's close, who knows, we may be in a similar situation. So no predictions, but there are some similarities that I thought were worth pointing out. So 2023 leadership, it's so important at the beginning of the year to find the leaders. So we mentioned all throughout January that the institutions are starting fresh on their performance. So they're always willing to take a little more risk early in the year as portfolio managers are trying to get up to a good start. They want to beat their benchmarks, and they want to get their bonuses. So we always want to pay attention in early January where the money's flowing. We talked about the importance of Russian dolls. Industry group action was the next level of peeling off the Russian dolls. Starting off the year, we're looking for clues. We're looking for themes. We're looking for those themes that institutions see 6 to 9 months ahead. Now, it's important. Former leaders are not likely to lead again. Coming out of the dot-com bear market, there was a group called the Four Horsemen: Dell, Cisco, Oracle, and Intel. They were really highly watched, great stocks throughout the 90s. But after the dot-com bust, these stocks were generally underperformers. They never really led the market again. Early 70s, we had the Nifty 50, names like McDonald's, Eastman Kodak, Rite Aid, Coca-Cola. They led the market in the early 70s. But again, they didn't lead future market cycles. And, probably starting in the 2010s, we have the FANGs. Everybody loves Apple, Amazon, Netflix, Google, Meta, Facebook. But these are really over-owned at this stage. And the question is, none of these companies is going out of business, but will they be the big leaders that they were in the past? It's not likely. They're heavily over-owned. It takes a lot of money to really push them ahead. And they're not growing at the paces that they used to. So I think it's important. The message is be open to new names, both big and small. So let's look at where the leadership is pointing us towards in 2023. So I've pulled some groups together, and I like to do this. I like to look at group charts, and I like to see what the action is in the first couple of months of the year. So here's the home builders, an unlikely group because of interest rates. But you'll notice that the home builders really started to move up in this orange box, which started in November. And look at the acceleration we've seen in January. The home builders are up 12% for the year. Very, very good. Here's four names you might want to look at a little closer. They're coming off big, big, big cut bases, and they're pausing right now. But good action from the home builders. What they're probably signaling is 6, 9, 12 months ahead, interest rates might be coming back down. Here is the leisure gaming group. Again, leisure gaming is up 17.5%. Wynn, Las Vegas Sands, Melco, these are really strong stocks. Again, they're pausing after a big move, but it's showing us there's some leadership in the leisure group. Next one is semiconductor. It's been broad semiconductor strength. The equipment makers are up 22%. The fabless semiconductors up 26% to date, and the manufacturing semiconductors is up 20%. A lot of interesting names. There's some new names here, which is really, really what we're looking for. AEHR, ALGM, on semiconductor, Mobileye. So there's some new merchandise to look for here. You'll notice that the semiconductors really started to turn and make this move starting off the October lows, October 13th lows. So this is a group that's getting pretty hot. So we'll have to see how it continues, but it's certainly one of the stronger groups. Next one is software and payments. Enterprise software, which was a big leader before the market topped, is up 14%. Many of these stocks are still in bottoming patterns, but the payment processors are also doing well, up 14% year to date. And look at this box. This is from January 1st. Look at these steep angles of ascent you see in a number of these stocks. Toast and Four are both payment processors. There's a lot of AI stuff going on with Sumo and AI. Inta is another AI stock. So there's a lot of stuff going on here that I think is worth noting when we're looking for leadership. Travel booking. I took this snapshot actually yesterday. This group got hit hard today, but still they have had a big run up. So it's not unexpected for them to get a couple of days of weakness. We'll see where it goes. But Booking.com, Airbnb, Expedia have had a really, really strong move to start the year. The group is up 23.5%. Another group is really not a group per se, but it's all of the infrastructure names. There's a lot of strength in infrastructure based on the congressional bill that passed. Some of the steel stocks, some of the leasing companies, metals, industrial things like CAT. PAVE is actually an ETF of the infrastructure stocks. And you can see, they were kind of going sideways, but right as the new year, there's certainly money flowing into these stocks. Look how strong Steel Dynamics has been since the year started. So let's get now into the pullback and the indices. What's going on in the indices? So we mentioned we're going to look for evaluating the pullback. We're trying to determine, is the action normal or is it abnormal so far? So how do we do that? Well, we're looking at index and we're looking at leading stocks. So the question is the market and or leading stocks pulling back gently here and it's kind of crouching before we have another move higher? Or is it abnormal in the market and the leading stocks? It's like touching a hot stove, ouch, and they're sharply dropping. We're trying to answer these questions. The things that we're looking at is the percent of the pullback that we see. We are looking at key support levels. Are they holding or are they deteriorating? What's the volatility like? Is it increasing or is it stable? And then what is the action like in these individual leading names from some of these top groups that we just talked about? So we're still in this period off the breath thrust. We're in the first 6 weeks, and we talked about 3 to 5% pullbacks would be normal. So I've used this slide before, and we talked about if the S&P came all the way back down to look to touch the downtrend line and or the 200-day moving average, that'd be about a 5.8% pullback. Whereas right now we're only about 3% off the highs in the S&P. So everything is actually within norm, acting normally. We had a couple bad days yesterday, and today was not great, but so far so good with the pullback. Here's the NASDAQ. The NASDAQ, we talked about January being extremely strong after the follow-through day. We've had multiple consecutive accumulation days, which is a sign of real strength that institutions are in there buying. We knew we were very extended at the end of last week, and not surprisingly, we've pulled back. We had a distribution day yesterday of about 1%. It was not a good day. Today, as of 3:25 in the afternoon, the NASDAQ was down 0.9%. We might get another distribution day, but we have to watch the final volume totals to see if the volume's increasing. I haven't seen it yet. So the action was very strong, thrust up, and we're coming back down. Here's the 21 EMA. We'll see if we get some support. I tweeted this out yesterday. Yesterday was a bad day, but there are going to be bad days in a rally and an uptrend. And I just wanted to remind people that during the COVID recovery period, I pointed out there were some very scary bad days on this uptrend here. There was some 3% drops, there were some 2% drops, there's a 5% drop. These were all very scary, and I recall these as being pretty a big test on your nerves if you held positions. But the key thing was the key level, in this case, the 21-day exponential moving average. It actually contained all of the scary pullbacks. So it's just something to be aware of. It's not unusual to get some distribution after we had a strong rise here in January. So the action on the pullback, leading stocks. What's the action look like? Well, Rambus, after a sharp sell-off, we had a very quick recovery, and we've actually are near new highs. That's a positive, very good action. ALGM, you really don't know there was a pullback in the indices. It's been acting very strong, very positive. On Semiconductor, got through its earning report, out, it's still holding. Again, positive check mark for those leading stocks. In some of the younger IPO type stocks, here's 4, has a gentle pullback coming into the 21 EMA, declining volume, constructive. CRDO, it's holding its breakout level, constructive. Mobileye, it's holding gains, that's constructive. ON, it's pulling back to form a handle to a base. The volume is declining a bit. I consider that to be constructive. Clear, Secure Clear, this one failed at the breakout and it's pulled in pretty hard. I don't think this one is acting as well as the others. I think that a negative. Some of the other bigger names, CMG had a failed breakout after its earnings report, disappointed. That's a negative. Axon, the breakout level failed. We had a high volume shakeout day, not great action there. Win had a gap up on its earnings report. It's been holding well, so that's a positive. And Shop has been pulling back very gently and declining volume into its 21 EMA. That's constructive. And as I mentioned before, the builders, this is D.H. Horton, Lennar, all pausing near the highs of a big base after a good run-up. That's constructive. And I mentioned that the leisure travel booking sites, Expedia, Booking, and Airbnb all got hit today with volume. That's a negative. But you can see, and I've just pulled a handful of names. You could pull others. On balance, there's still some pretty good action from leading stocks. So when we're answering these 2 questions, are we crouching before another move higher, or are we touching the hot stove? Let's look at the report. The percent pullback, the S&P has pulled back 3% so far. Very normal. I'll give that an A. Are we holding key support levels? Yes, both the S&P and the NASDAQ are still holding downtrend lines that could act as support. They're above the 200-day moving average, and the NASDAQ is still above its 21 EMA. That's also an A on the report card. Volatility, it rose a little bit this week. I think the VIX was up a little bit this week. Not alarming. but some volatility as we're pulling back. So I think the VIX is, the volatility is a B on the report card. And I think action of individual leading names, on balance, things are still acting very well with some of the leading names that are moving. I think there's a B plus there. There are some roadkill for some stocks on earnings, and there are some ones that have not held breakout levels. But on balance, some of those leading groups are still acting really, really well. So the summary for the week is we came into the week extended, the market's pulled back, but we seem to be getting some support. We still got a ways to go to get down to some of these levels, so we could keep pulling back. We talked about 5-6% would still be normal. There seems to be a real battle between institutions. Some of the institutions clearly are accumulating stock, and we're seeing accumulation days, while there are still other institutions that are bearish and they're shorting. So we're getting there's a lot of cross currents going on, but on balance, it's no longer one side bearish. The monolith of bearishness is broken, and we're at least having a tug of war now between bulls and bears. Hopefully, we can see the bulls eventually become the majority and get a nice uptrend. Leading stocks hanging in there well. When you have these pullbacks, it actually becomes easier to identify the leaders. Some of those names in that slide, you might want to check their charts. There's some real leadership starting to develop. And with the pullback, we'll learn more on the pullback. The leaders start to shine. And on the ensuing rally, we'll see which ones recover quickly, giving us further clues on where the leadership is. The internals we mentioned, they're still strengthening. That's a very good sign. Even though we're pulling back, we're not seeing big deterioration in new highs or the advanced decline line. Even though there is some volatility still, you got to be careful. Entry points and controlling your risk is important. You can't be sloppy or you're going to get yourself in trouble with sloppy entries and trying to control your risk. Or if you add too quickly to positions, you'll get stopped out. So you have to watch that average cost, be strategic. I still think it's still kind of hard to get too aggressive in this environment if you're a position trader, really because of the second bullet. There's still a battle between institutions accumulating, which are starting to win, but there are still many institutions that think we're going lower and they're bearish. So it's a struggle right now, but if you can get positioned properly, when we come out of this pullback, we could get another move higher. So I'll leave you with the quote. I measure what's going on and I adapt to it. Try to get my ego out of the way. The market is smarter than I am, so I bend. This came from Martin Zweig from his book Winning on Wall Street. He was a fund manager, really emphasizing flexibility is so important in the market. So try to stay flexible in the pullback. Watch your stops. Also keep your watch list fresh, looking for the leaders. That's all the time we have for this market update. It's February 10th, 2023. I hope to see you on the next one. You can find me on Twitter, YouTube, and I'm always looking to hear from you on rainkingblullbear@gmail.com. Thanks, everyone. We'll talk soon.